Have you ever bought a stock after watching it rise 30%, 50%, or even 100%, thinking, I have to buy it now, otherwise I'll miss the opportunity? And then, just a few days later, the stock starts falling. You panic. You tell yourself, I'll wait for a recovery. But the recovery doesn't come. Finally, you sell at a loss. And then, something strange happens. The stock starts rising again. If this sounds familiar, you're not alone. Millions of retail investors repeat this cycle. But why? The first reason is FOMO, fear of missing out. Imagine a stock trading at 100 rupees. You ignore it. Then it moves to 120 rupees. Still, you don't buy. It reaches 150 rupees. Suddenly, you start paying attention. At 180 rupees, everyone on social media is talking about it. At 200 rupees, you finally think, this stock is going to 300 rupees. So you buy. But here's the problem. The stock didn't become attractive because it was cheap. You became interested because its price was going up. And when everyone starts believing that prices can only rise, that's often when risk becomes much higher. Today, FOMO is even more powerful because of social media. You open YouTube, Instagram, Telegram, or WhatsApp, and suddenly everyone appears to be making money. Someone bought a stock at 50 rupees. It became 150 rupees. Someone turned 1 lakh into 5 lakh. Someone says, this stock is the next multi-bagger. But what you don't see are the people who bought at the top. You see the winners. You rarely see the losers. And your brain starts thinking, if everyone else is making money, why am I sitting out? That's when investment decisions become emotional instead of rational. There's another powerful force at work. Herd mentality. Humans naturally feel safer when they're part of a crowd. If thousands of people are buying something, our brain assumes they can't all be wrong. But markets don't work that way. When everyone is buying, who is left to buy next? Think about it. A stock has already risen dramatically. News is extremely positive. Social media is full of excitement. Analysts are talking about it. Retail investors are rushing in, and everyone believes the next move is higher. At that point, the market may already have priced in much of the good news. And when expectations become extremely high, even slightly disappointing news can trigger a sharp fall. Now comes the second half of the cycle. You bought near the top. The stock falls 10%. You say, it's just a correction. It falls another 10%. You become uncomfortable. Then comes a major negative headline. The stock falls 30%. Now fear takes control. You don't think about the company's fundamentals anymore. You think, how much more can I lose? So you sell. And this is where the painful irony happens. You bought because everyone was optimistic, and you sold because everyone became pessimistic. In other words, you bought when emotions were high, and sold when emotions were low. So what's the biggest mistake retail investors make? They confuse price movement with value. A stock going from 100 rupees to 200 rupees doesn't automatically mean it will go to 300 rupees. And a stock falling from 200 rupees to 100 rupees doesn't automatically mean it's a bargain. Price tells you what the market is currently paying. Fundamentals help you understand what you're actually buying. Before buying a stock, ask yourself, what does this company actually do? Is its revenue growing? Are profits growing? Does it have manageable debt? Is the valuation reasonable? And most importantly, if the stock falls 30%, would I still want to own this business? So how can you break this cycle? Here are 5 simple rules. Rule number 1. Never buy simply because a stock is rising. A rising price is not a reason by itself. Rule number 2. Don't chase social media stocks. By the time a stock becomes the hottest topic online, a lot of investors may already be in. Rule number 3. Have a written investment thesis. Before buying, write down why you're buying. If you can't explain your reason in a few sentences, you probably shouldn't buy. Rule number 4. Don't invest all your money at once. Using a disciplined approach can reduce the emotional pressure of trying to perfectly time the market. And finally, rule number 5. Think like an owner, not a gambler. When you buy a stock, you're buying a small part of a business. Don't ask only, what will this stock price do tomorrow? Ask, where could this business be 5 or 10 years from now? Remember this. The market doesn't force you to buy at the top. Your emotions do. FOMO tells you, buy now. Greed tells you, it can only go higher. Fear tells you, sell before it falls more. And these emotions can turn a good investment into a bad decision. The goal isn't to predict every top and every bottom. The goal is to build a process that protects you from your own emotions. Because in the stock market, patience is often more profitable than prediction. If you've ever bought at the top and sold at the bottom, don't worry, you're not alone. The important thing is to learn from the mistake. If you found this video useful, like the video, subscribe to Naveen Finance, and share it with someone who needs to hear this. And remember, don't chase the market. Understand it.